really work with Farm Bureau every day in a lot of different ways, and we're great partners, and I want to thank Farm Bureau for the opportunity to be a partner every day and to make a presentation such as this. The way we usually do this is that the next person I introduce is Dr. Lee Maynard. Lee is the chair of Ag Econ at UK, and I think everybody here is an Ag Econ employee except your Forestry Department Chair, Jeff Stringer, but everybody else will be introduced a little bit later. But before I turn it over to Lee, I want to let you all know that this is the last time Lee will be presiding at this event because he is stepping down as Department Chair of Ag Econ, and we are all going to miss him so much. There are rare department chairs that I've worked with that are as thoughtful and caring about the faculty and the students and about extension and agents as Lee is, and I would like to give him a special round of applause before he comes forward.
Well, thank you very much, Dean Cox. I wasn't expecting that at all. Good morning, everyone. Good morning. Thank you all for being here. I'm Lee Maynard, as Dean Cox said, Chair of the Agricultural Economics Department, and we're very happy to be on the program again this year. A big thanks to Eddie Melton and Mark Haney and all the folks at Kentucky Bureau. We got a panel of experts here today to share with you a summary of 2017 ag and forestry markets, and then they'll look ahead at expectations for 2018. We're going to start with Will Snell's comments on the U.S. and Kentucky ag economies. Next up would be Kenny Burdine, our livestock and meat specialist. Then Todd Davis for the grains outlook. Back to Will, I believe, for tobacco, followed by Tim Woods for horticultural markets. Jerry Pierce will talk about farm incomes and living expenses. And we'll wrap up with Jeff Stringer, who will summarize your forest product markets. Is the mic not on? Can folks hear me okay? No. Oh, well, we can always do that. Thanks. And there's a summary of today's comments in the back, this one-pager that you can pick up if you like. And after the panelists finish presenting, the way we usually do it is we take questions from the members of the press first, and after they've satisfied their curiosity, then we'll open it up to questions from the floor. So without further ado, let's start with Will Snell on the U.S. and Kentucky ag economy.
Thank you, Lee. Good morning, everyone. Certainly a pleasure to be here. Eddie, we look forward to this every year. We appreciate the time that you all give for us to have on the program. Personally, I've had an interesting 2017. I've got to experience what many of you all have experienced the past 2 or 3 years, dealing with some cash flow challenges, liquidity issues, and drawing down equity, as I had the opportunity of taking not $1 but $2 down the aisle this past year. The good news for me is that I'm out of daughters to do that. But the good news that we have, I think, for you all is after some challenging years, the past 2 or 3 years, that at least we feel like the bleeding has slowed down. I don't know if it's stopped or not. As Eddie pointed out, we've got a lot of challenges. But for the most part, 2017, I think, for Kentucky and U.S. agriculture will go down as a year of stability and maybe transition to hopefully some better years ahead. Yesterday, actually, USDA came out with their estimate of net farm income on the U.S. level. And as you can see there, their number indicated a little bit of increase in net farm income for 2017. But the bad news, of course, is the fact that just like many of you all, in terms of net farm income being down about 50% or so from the levels that we saw several years ago. And, you know, that just followed a very unprecedented 6-year run-up in terms of net farm income across the nation. As far as cash receipts, USDA had cash receipts up about 2.4%, led by some growth in livestock. both prices improvement as well as increased volume of livestock being sold. Again, on the price side, after 3 very, very challenging years of declining prices, we have seen some improvements, again, primarily on the livestock side with some growth in prices that Kenny will talk a little bit more about later on. As far as production expenses, again, a year where we saw fairly stable input prices. We had a little bit higher labor cost, a little bit higher interest cost, higher fuel costs, but this was somewhat offset by lower fertilizer prices, lower chemical prices, as well as lower feed prices. As far as government payments, USDA is projecting that government payments would be down close to $2 billion in 2017, and probably not surprising given the structure of the last farm bill with those benchmark revenues coming down as a result. Those ARC payments came down about actually about 40% from the year before, while PLC was higher, but again, the ARC payments were down more than the PLC payments were up, and as a result, those government payments have been reduced for 2017. As you can see there, in the last couple of years, government payments have accounted for closely 20% of the national net farm income. And then we come to trade. Heard much about trade this past year? Certainly been in the news a whole lot, continues to be an important part. There's no doubt that we in agriculture are watching this debate and discussion very closely. Trade, as we know, is extremely important to U.S. and Kentucky agriculture. You can see here this slide shows that trade now accounts for over 30% of the value of U.S. agricultural production, and the numbers are actually higher on a percentage basis for Kentucky. But we did have a pretty good year despite all the discussion and debate relative to the trade issue. You can see there that ag exports rebounded this past year, up about $10 billion. Pretty much increases across the board in terms of the value of increased U.S. agricultural exports. Certainly ample U.S. supplies, lower contributed to help that, but we also were benefited by the fact that we were seeing some growth in the world economy since the recessionary period back some 5-7 years ago when we had the global financial crisis. In fact, it's the largest annual growth in the world economy since, I think, 2010. Another factor that's contributed to that growth in exports is somewhat a surprise in the value of the dollar going down this past year. I think a lot of us anticipated with more aggressive action by the Fed that we would see that dollar continue to increase. But as you can see with this next slide, that despite an increase in the value the past couple of months, that overall the value of the U.S. dollar is down about 6% for the year. And certainly this has contributed to increasing the price competitiveness of U.S. agricultural products in the world market. We actually export agricultural commodities and products to nearly 200 countries worldwide. But as this pie chart here shows, there are three countries in the news a lot relative to trade, extremely important for our trade picture: China, Mexico, and Canada. Those three markets comprise about 45% of all our agricultural exports. And I think there's no doubt that some of the strength that we've seen in our commodity prices this year certainly can be attributed to a fairly strong export market. There's also no doubt that if we have any major trade disruptions in any of these major markets, it's going to have serious implications for the future of U.S. agriculture as well as impacting Kentucky agriculture. As far as the balance sheet for U.S. Ag, I think many of us are probably still surprised how well land prices have held up during this downturn in the farm economy. A lot of that probably can be attributed to the fact that we've had relatively low interest rates that have kept the value of farmland relatively high. Certainly competition for ground in certain areas has contributed to that as well. But the combination of low interest rates as well as some of you all utilizing cash to buy equipment and land several years ago has somewhat constrained the growth in the overall debt numbers facing U.S. agriculture. We haven't seen debt increasing at a very rapid rate. And as you can see there, after a little bit of reprieve in asset and equity values the past couple of years, that USDA is now projecting that those asset and equity values will rebound or have rebounded this past year. So again, the combination of strong asset and equity growth as well as relatively low debt levels, or the growth into debt levels, have enabled these financial ratios that Jerry will talk a little bit about from a Kentucky perspective. You can see that even though they have increased a little bit the past couple of years, Wayne, they're still very, very much lower than what we saw back in the early 80s with the farm financial crisis that we experienced some nearly 30 years ago. But there's no doubt that some of our lenders becoming very, very cautious at this point, especially if this ag economy continues to be in the doldrums in the years to come. We've got some of our farmers out there, some of the younger farmers, some of those highly leveraged farmers, some of those farmers that we would deem the lower third in terms of management with high cost structure, maybe low yields, that those farmers, despite these still favorable financial ratio levels, that some of those farmers are, a concern to our lenders out there. And again, it really depends upon how long this current ag economy remains at current levels on, the impact that it will have on their bottom line, and the willingness of some of our lenders to continue to work with these individuals to maintain them in agricultural. So what about Kentucky? This is a slide we put together every year. You see that we peaked in 2014 with $6.5 billion of agricultural cash receipts. Last year at the press conference here, we projected that the 2016 ag cash receipts would decline to about $5.4 billion. And when the official number came out this past September, that's the number that USDA made official, was $5.4 billion. So this past year, the current year, 2017, we are projecting that we will see a little bit of recovery in those cash receipts, up to about $5.6 billion. Pretty much across the board in terms of growth in livestock receipts. And again, a lot of this, Kenny, was built upon stronger livestock prices that Dr. Burnine will talk about here in a few minutes. Our soybean receipts are up, due to some very, very, or the growth in yields as well as acres for soybeans. Corn receipts, even though prices are not where many of you all would like for them to be, certainly our yields have been able to support and maintain those corn receipts despite the price environment. And we had a much better year with tobacco, rebounded in 2017 as well. If you look at the distribution, poultry remains the largest agricultural enterprise in Kentucky, around 20% of our ag cash receipts, followed by equine, soybeans, cattle, and corn round out the top 5. What about net farm income? If you go back to that 2011, 2015 period, I kind of like to look at a multiple year period looking at net farm income, because these numbers are very vulnerable depending upon the timing of some of your sales, especially on the grain side. You can see we averaged close to $2 billion during that time frame. Last year, we were down to about $1 billion of net farm income. So again, that 50% drop that we saw at the national level, we've also experienced here in Kentucky. But we're projecting, based upon higher cash receipts and some stable input prices, and Brian, a little bit improvement in those government payments that you sent back out in October, that as a result, we will see a little bit of recovery in that net farm income for 2017. Again, a lot of this picture, or some of this picture in terms of the decline that we've experienced the past few years, can be attributed back to the fact that, those government payments are not as large as they used to be. We used to get these buyout payments, which really supported our net farm income numbers. And you can see that downward trend. But again, unlike the national numbers, which indicate that the government payments are going to be down this past year, based upon those checks that FSA sent out this past year, we expect government payments for Kentucky to be up a little bit for the 2017 calendar year. What about 2018? Pretty much flat. Again, we don't see a whole lot of growth in too many of our agricultural commodities for 2018. You've got poultry and equine rebounding a little bit. There's no doubt that ample supplies of meat products on the world market are going to continue to constrain the growth in livestock prices. And again, we have to really question whether or not Mother Nature will be as kind to us this year as it was going to be in 2018, that we had such favorable yields. So again, as I begin to finish up, we'll talk a lot up here about more on the supply side in terms of management, trying to protect against downward price risk in 2018, and also looking at some value-added opportunities in order to take advantage of that local and those differentiated products that are in demand at the local level. So my last slide is I'm over time here. Looking at 2018 and beyond, I think a lot of us are going to be watching what happens with the Federal Reserve, impacts on interest rates, as well as the value of the dollar. A lot of policy issues, Eddie, that you all will be following this year, certainly the Farm Bill, what's happening with tax reform, healthcare reform, immigration reform are big issues for agriculture, and those trade agreements, again, very critical to the future of Kentucky ag. And then finally, some issues with competition out there, as well as concentration. We've seen a lot of concentration, a lot of the agribusiness suppliers, as well as some of the processors, and some of the impacts that will have upon agriculture, not only in 2018, but in the future for not only our agriculture, but our agriculture throughout the United States. So with that, I'll turn it over to Kenny, who probably has the most brightest outlook of anybody on the panel today relative to livestock.
Thanks, Will. Appreciate it. And there's definitely some positive to discuss. We'll walk through several livestock species here in the next few minutes. So the poultry market at the national level was impacted quite a bit in 2015 and certainly 16 by avian influenza. What that primarily did, it impacted exports. And because of the export impact, it hurt wholesale prices some. And I think here in Kentucky, what that tended to do is that did delay some of the turns in our houses. I mean, there was a little bit more downtime between flocks for a lot of our operations. So as we think about kind of where that put us, and we think about 2017, poultry production is actually up for 2017, about 2%. If you look at wholesale prices, they also rebounded some as well, which is a pretty good indication of kind of where things are, because exports have picked back up. It worked to offset those production increases. You're well aware, too, back in the spring, I think it was, we had 2 cases of low pathogenic avian influenza in Kentucky. Those were fairly isolated, but something to keep an eye on, big picture. Looking ahead to 2018, we're likely to see somewhere in the ballpark of a 1.5% to 2% increase in poultry production for 2018. That's been the trend since 2012. We've seen poultry production go up between 2 and 3% each year. In terms of Kentucky, though, big picture stories, this is a growing sector. More houses going in, it continues to be a major piece of the economy. We project it to stay there. Hog markets have been pretty good to us for 2017. The price for eastern corn-bred hogs has been about $7 per hundredweight higher on a carcass weight basis this year than last year. If you look at kind of what I showed you last year, so blue line here is 2016, we talked about slaughter capacity in the hog sector being a problem last fourth quarter, and it was, okay? 2 new plants came online first of the year. The biggest difference in this year and last year has been that we've not seen that fourth quarter issue we saw last year, so we're going to have a little bit better year. Numbers are actually growing in the state in terms of hogs. A major integrator in West Kentucky has grown. USDA puts their hog numbers out December of December each year, okay? So we don't have a number for December 2017, but the breeding inventory for Kentucky December 1st, 2016 was up about 7% to kind of give you an idea of how fast this sector is actually growing. Thinking about 2018, the thing to understand is, and this has been a little bit under the radar screen, but we've actually seen as much growth, even a little bit more, in pork production as we have seen in beef production in the last several years. So we're going to see about a 4% increase in production. And that's going to be a common theme across our major meats, more production. So given that, it's hard to forecast those prices staying where they've been. I would look for our prices to average about $5 a hundredweight lower on a carcass weight basis for 18 than they did in 2017 would be my guess looking ahead. In general, post-recession, the equine market's been very steady. We bounced from those post-recession levels. We've held at pretty good levels since then. It looks like 2017 is going to be another increase. several things we can look at. Stud fees have been solid, okay? But I always kind of look at some of those major sales as indicators. The Keeneland yearling sale, for example, was up about 13% this year over last year. Their breeding inventory sale in November was off just a little bit, but the two major sales at Fasig-Tipton, both their yearling sale and breeding sale were up as well. So a lot of indication that this market has improved and is gaining strength. I look for it to be very close in terms of receipt levels, very close to what we saw back in very close to $1 billion pre-recession levels. I'll talk about dairy very quickly. So 2016 was a very tough year for dairy producers. 2017, U.S. all milk price and Kentucky prices for that matter are going to be up a little bit more than $1 per hundredweight, okay, which certainly helps things some. At the same time, feed prices are also just a little bit lower as well, okay? So the combination of stronger prices and a little bit cheaper feed are certainly going to help some in terms of margins. I want to be careful how I word this though. So I think 2017 was a better year in the dairy sector. It was not what I would call a good year for Kentucky's dairy producers, and I think that's important to understand. 1980, we had just under 250,000 dairy cows in the state. Estimate from USDA, January 1, 2017, was under 60,000 dairy cows. So we've lost a lot of dairy cows here in Kentucky big time. A lot of it, I think, comes back to just production cost differences between large commercial operations and smaller operations. Although we have some of both in Kentucky, we have a lot of fairly small family-oriented dairy operations here in the state. And I think that's evidenced by the fact that despite the fact that I don't think it's been a good year for Kentucky dairy producers, at the national level, the herd seems to be growing. And we're likely to see about a 2% increase in milk production for 2018. So given that, I'm guessing our farmable milk prices go back to about what we saw back in 2016. So I'm going to shave something close to $1 off of those in terms of forecast for 2018. The beef sector may be the most improved from when I talked to you this time last year. The current market is pretty close to what I might call a long-term normal, okay? So blue line here is 2016, red line 2017. We're about $30 per hundredweight higher price today than we were 12 months ago. Okay, so to put that in perspective, that's about $150 per calf sold. So pretty significant difference. So our cow-calf operations, while they're not thrilled, given where prices were a couple years ago, this is certainly a much better year than we saw last year. Remember, most of our operations tend to calve in the spring and wean in the fall, so this stronger fall calf market helps the majority of our cow-calf operations. My opinion is this calf market can probably hold reasonably well for two major reasons. Number one, it's been an outstanding weather year this fall, okay? It delayed our fall calf runs. Typically, your calf market bottoms when grass runs out in the fall of the year. Because we had such good pasture growth, we really saw our calf runs come much later and not be near as large as they had been in the past. At the same time, we're just now getting to the point in the year when wheat grazing operations in the Southern Plains start looking to place some of these wean calves into grazing programs, okay? So I think the combination of the good fall weather that we had, the smaller runs, and the fact that we're coming into that wheat grazing time period, I think this calf market can hold. Now, thinking about the heavier feeders, here's what I guess I would have to say. Your fed cattle market tends to break quite a bit from spring to summer, okay? Meaning prices for slaughter cattle in the spring of the year are almost always much higher than the fall of the year. And that's been especially true this year, okay? So very quickly, we're getting to the point where these heavier feeders that are moving through markets are not going to be coming off feed in the spring. It's going to be summertime. So lately, what we've seen is that there's been very little price difference between calves and heavy feeders, okay? So a 550 versus an 850, very little price differential. I think that's going to widen to more normal as we move through wintertime. Thinking about 2018, things to understand. First of all, this cow herd is still growing, okay? Grew a little bit in 2014, grew 3.5% during 2015 and 16. My guess is this herd grows something like 1% when the number comes out January 1, 2018, okay? So we're going to see a few more calves moving through auction markets in 2018. Also remember that beef production is a function of the previous year's calf crop, not the current year's calf crop, okay? So while our calf crop next year may be up 1%, our calf crop for 2017 was over 3% bigger, so we're going to see a much larger than that production increase on the beef side as a whole, okay? And big picture, we think about where we're headed, bottom line is we're going to see increase in all major meats, 3 to 4% increase in beef, close to 4% in pork, and about 2% in poultry. And I don't think exports can absorb all that, which tells me per capita consumption is probably going to have to rise. So I can't give you an increasing price forecast for calf prices year over year next year. My guess is we'll rally in spring like we always do. I would personally put a dime to 15 cents a pound on these calf prices between now and springtime. Comparing next year to this year, I would pull them down somewhere between a nickel and a dime from where they are right now. So I think we're going to see a little bit lower calf prices in 2018. In terms of strategies and what I would think about doing, calf operations understand this is a more normal market, okay? And I think we need to look at it that way. So focus on efficiency, make decisions like that. You know, understand that what may have made sense in terms of keeping cows around when calves were selling north of $2 a pound is probably not the case now, okay? So we need to go a little bit harder and think a little bit harder about some of those decisions. My margin operators, stocker operations backgrounders, okay? I would encourage you to be very opportunistic. I'm not going to talk about winter backgrounding margins in this particular session. I will this afternoon at the beef session. But I will tell you that given where calf prices have been and what feed prices are right now, there has been some room to place calves in the winter backgrounding programs. They've looked pretty good, better than they have the last 2 or 3 years. So do be aware of that. Because I think we're going to see some production increases and this cow herd's still growing, while I would be optimistic about placing calves in those types of programs, I would also be thinking about downside price risk and doing something to protect myself on the sales side on the back end. So I'll hand things over to Dr. Davis to discuss the grain outlook.
Good morning, everybody. If you were here last year, you might remember that my friend Jerry Pierce hung a label on me as Dr. Doom and Gloom. And I also want you to recognize that none of my colleagues rose and vigorously defended my honor. So I guess there might be something to it. I want to start off with this graph, which is just the index of the corn, soybean, and wheat price relative to the price back in '06. And you guys know the story. You lived through it. But it shows that when you had domestic demand and export demand increasing year over year at an increasing rate, and you had years of below trend yields, made for some tight stock situation, that led us to 2012, where the corn, which is the red line, and beans, which are the blue line, was 120% above where we were in '06. And it was such a bull market that it even pulled wheat up to about 80% above where it was in '06. And of course, you also lived through the last few years, as once we've had the combination of demand increasing at a slower pace, and we've had large crops, we've been rebuilding stocks. And what I want to point out to you here is that corn and wheat have returned to about the price level where we were back in '06, and soybeans have landed about 45% higher. Now, we all know that costs don't come down as fast as the market price, and this will probably set the pace for Jerry's discussion of the farm financials. So looking at the corn outlook, in the bidding for acres, and it wasn't necessarily bidding as much as trying to discourage, the market was trying to discourage corn. And nationally, harvest area was reduced by about 3.6 million acres from the previous year. We're going to harvest about 83.1 million acres. In Kentucky, we followed the national trend. We've reduced harvested area by 160,000 acres to 1.24 million acres. So that was a positive step for the corn market. And the weather during the growing season nationally could not be described as ideal. You had a too wet planting season in the eastern corn belt. You had droughts in the Dakotas and parts of western Iowa. And the market was anticipating something less than a record yield. But I think a testament to the technology that's available is that the November report pegged the yield at a record 175.4 bushels an acre. And then for Kentucky, we're at a record 177 bushels. So again, we've tried to reduce production on the amount of area, but Mother Nature and technology handed us a home run. So what we're looking at is the second largest crop on history, about 14.6 billion bushels. And when you add in carry-in and imports and whatnot, you're only looking at about 20 million bushels less than last year in the marketing pipeline. we've been very fortunate to have strong feed demand, and industrial use is kind of going with trend now. We don't have the same year-over-year demand increase for biofuels. The wild card is always going to be exports. They're looking to be down about 368 million bushels from last year, and what that's going to do is increase carryout to about 2.5 billion bushels, or about a 17% stocks to use. And the USDA says that would be about a $3.20 U.S. farm price. Now, just given our basis and everything, you can add about 25 cents a bushel to bring that to a market near average price for Kentucky. Now, the blue column is the production for the U.S. for corn. The red is total use. And I want to draw your attention that from 2010, 11, and 12, that red column's taller than what we produce, which is good, higher prices. Now I want to draw your attention to the right side. The last 5 years, we've had production outpacing use 4 out of 5 years. So again, you know the story. We just have large crops or sufficiently large crops, and that adds to the carryover. So when you look at sheer volume of corn, we are at the largest quantity of corn in the bins since 1987. I put that in red because some of you who've seen this movie before in the 80s might recall the disaster. But what differs from the 80s is that we have much stronger demand. This amount of stocks used back in 87 was about a 200-day supply of corn in the bin. And because our use is much larger than 30 years ago, we're only about 63-day supply. And I know it's tempting when you're in a policy meeting like this to think about what can we do different. And I just want to point out maybe some other organizations, not Farm Bureau, would say, let's do supply management. Let's be realistic of what reduced the mountain of grain in the 80s, and that was the 1988 drought. It wasn't anything that the smart people in D.C. did to get rid of our quantity of corn. Globally, we benefit by having a slight reduction in global stocks, and I want to point out China. Now, China is an interesting country because the government made a strategic decision during the tight stock years, high price years, to just inventory a lot of corn, and to the point where they had over 50% of the world's stocks in 2015. They realized when you carry inventory, that gets costly, and you can't store corn like tennis shoes. Corn deteriorates. So they changed their policy, and they only hold about 40% of world stocks, and they've also are trying to start an ethanol program that you always have hopes of China importing corn, and I guess that would be in the out years, but I think for now China's just trying to find a way to, through feed and through ethanol, to use all of their bounty. Soybean, again, the market was screaming for acres. We planted about 6.8 million acres this year, and we have a surprisingly good yield of about 49.5 bushels an acre. And in Kentucky, we expect to harvest about 1.95 million acres at a record yield of 52 bushels an acre. So bountiful crop for the U.S. and for the nation, record production, record supply. And fortunately, we have very strong demand, and when you talk demand globally, that's China. They're the market for North America and South America. And because of China and our strong demand domestically, the USDA has the price paid at $9.30 a bushel for the U.S. price, and you add a quarter to it, that's a good estimate for Kentucky. And again, I just want to point out, on the last, while corn had 4 out of the last 5 years of having production more than use, it's really only the last 2 years in soybeans that we have had production outpacing use. And so it's just the market has found a way to find a home for all of our production, to the point where USDA has the largest stocks in about a decade, since 06. And in 06, we would have about a 68-day supply. This year, it's paid at 36 days. Now, the market's anticipating, at least the analysts are anticipating, that 425 million bushels of inventory to come down. They think that because in the last 21 years, USDA has ended up reducing stocks 80% of the time. So I'm not necessarily a gambler, but if I was, I would bet that that number is going to come down. And the average has been 125 million bushels. And to be clear, I'm not saying that they will reduce it by 125 million bushels. Press, I did not say that. But let's just keep our math simple. 425 minus 125 is 300 million bushels, I think. I'm an economist, I'm not good at math. But if we did drop it down to 300 million bushels, that's at a 6.5% stocks to use, and that's getting tight enough for the market to sit up and pay attention. So the point is, corn has plenty of cushion. The bean market has not a lot to absorb a hit either in South America or the U.S. So for wheat outlook, now wheat's a crop. I'm going to put on my doom and gloom hat. Frankly, the wheat market has been begging to shed acres, and again, farmers responded by harvesting 6.3 million acres less than last year. And frankly, Mother Nature did what needed to happen by giving us a below trend yield of a 46.3 bushels an acre. Now in Kentucky, we have harvested 60,000 fewer acres to 340,000 and a slightly lower yield of 75 bushels an acre. All of this is really good news. We have 330 million bushels in the fewer bushels in the pipeline than the previous year. The bad news is that exports remain to be an issue. We are projected to have 55 million fewer bushels exported this year than last year. And market prices rewarding the tight stocks and all the other types of wheat except soft red winter. So when you aggregate them together, like what USDA does, you show the overall farm price increasing up to $4.60. And if you want to adjust that back to Kentucky, you could take about 30 cents off that. But that's more of a reflection of anything other than soft red winter. So globally, the good news, I guess, is that our stocks to use level is below 50% for the first time in a couple years. And globally, it's come down a bit, but we're still about a 100-day supply of wheat. As always, a supply problem in the U.S. or globally would be nice. And we are a residual exporter, that if there is a problem somewhere, the world can come to us and our exports will increase. So for thinking about 2018, my estimate of RP insurance projected price, which is really the only safety net crop farmers have, is about $4 a bushel. I give you the range. And that's just a little bit higher than last year. Bean market looks a lot more promising with my midpoint of my range of $10.40 a bushel as compared to $10.19 last year. So a ratio of those prices tends to favor beans as far as what the market is asking for as far as planted acres. I think what farmers actually plant will depend on conversations with their banker on how much they can get financed and also their agronomic preferences. I think in Kentucky, though, there's a strong case for soybeans to be more profitable than corn. And I just put this in there for your policy discussion, is on the Ark County safety net. And you see that the blue line is your Olympic average corn price used in the guarantee, and the red is the beans. If you want to through the evolution of the bill, corn's Olympic average declined 30% from the start of the legislation, and soybeans have declined by 22%. So I know that you guys will talk about policy regulations, and I imagine the discussion on how do we make our county viable in the future is going to be part of it. So anyway, I will turn the conversation over to Tim to talk about specialty crops.
Great, thank you, Todd. Good morning, everybody. And just a few observations, some comments on specialty crops and our efforts in diversification in Kentucky. We continue to see a lot of effort and energy and resources put into a wide variety of these kinds of specialty crops characterized by high input, high value, but also high risk and a lot of sensitivity to consumer prices. This kind of sums it up nationally. Flooding, hurricanes, and drought. Okay, these things hugely impacted the produce industry, particularly vegetables. So Florida, Texas, the whole Gulf area, the Carolinas, those folks were hit extremely hard. The good news is that wasn't us. Okay, so we didn't, we were not impacted in terms of production space anywhere nearly as badly as those folks that were down in those more vulnerable areas, which meant very strong prices for our producers, and especially in the fall, and some folks kind of winking and nodding at each other as they were taking their checks back from market for pumpkins and watermelons and other things in the fall market this year was just a very good market. And so you can see here, just to kind of give you a big picture summary of where this market has been in Kentucky, we will see, and this is actually, I think, relatively conservative, we'll see the highest farm gate cash receipts for specialty crops than what we've ever seen in Kentucky. And a lot of that driven by just a really strong market here. A lot of the markets for produce particularly continue to emphasize a lot of the direct-to-consumer markets, the farm markets, on-farm retail. We're seeing more CSAs and other kinds of programs like this, direct-to-restaurant. Of course, programs that the Department of Ag has put together, as I'll mention here shortly, have really helped support and promote and encourage a lot of the market activity of the local products to local markets. Continuing to see a lot of growth in this farm market space, which has certainly been a big activity in Kentucky, but nationally following those kinds of patterns as well, as consumers more and more interested in these where does my food come from kind of question. And so working with my colleagues over at the Department of Ag, we just see we now have more community farmers markets than what we've ever had before, and up close to 2,800 vendors that are selling at these markets. And so while this is not a big dollar value, these are high-profile, visible places where agriculture is seen by our residents across the state. The Department of Ag continues, as I say, to put a lot of effort and resources into this. That has been a huge, huge help to our folks that are doing the marketing local products into these markets, helping our restaurants and our grocers, other institutional markets identify these products to our consumers as local products. And I don't mind to say, I think our Kentucky Proud program, compared to state branding programs that we see in other states, is one of the strongest that we have out there. As I mentioned, a lot of other activity that's going on with the agritourism and on-farm retail markets, wineries, and even garden centers that all saw relatively good years. Just a couple of points on the wineries, just to kind of give you a little update on that. For a number of years, I was kind of waving the flag and showing what spectacular growth we saw, especially if you look like, say, from 2004 to that 10-year period, going from 4 to about 58 wineries. Huge growth, and that has actually kind of plateaued. Still some kind of growth in terms of numbers overall, but you can see even regionally down there in that bottom line, kind of a plateauing, a maturing, at least in terms of the number of wineries that are out there. And while we don't see a ton of new wineries coming into the market, we still see a very strong market there. And just if you look at just this statistic here about wine that has actually been bottled, we don't have all of our bottling data in yet for 2017. This is just estimating it, but we're probably going to have the most wine bottled that we've ever had in Kentucky. And before we all get super, super excited about that, just to provide a little bit of context, Kentucky is still tiny, tiny compared to our neighbors in Indiana, Ohio, Illinois, and Virginia. So I think there's still a lot of upside potential for us there in terms of growing those kinds of opportunities. And as we look at our bourbon and other kinds of the craft brewing and other kinds of distilled liquor markets that we see across the state, lots of consumer interest in these kinds of local products and local markets, and an important part of the agriculture story in Kentucky. So just to tie a couple of things together, I really do need to mention the importance of the growth of the produce markets. I think these have been one of the bigger drivers that we've seen in growth in Kentucky. But I put this little graphic in here just to show you it's not just a Kentucky phenomenon. We're seeing these produce markets showing up really all over the Ohio River Valley states and continuing to grow in number and in scale. And any of you guys that have been out to see the Fairview produce auction out there in Hopkinsville know they've just continued to expand and expand and expand. Lots of marketing infrastructure that's being put in place and generally benefiting, again, from a very strong market. So expecting to see kind of market growth across all these different market channels, looking ahead here to the next 2018, 2019 relatively bullish outlook. So just to just say a couple of things that I wanted to mention on the green industry, the nursery sector, which is still our largest contributor to our overall cash sales in our horticulture sector. The thing I wanted to point out, this is from a couple of years ago, but it emphasizes, highlights something that's really important. You can see that on the far left, crop production, and that's the scale of farm gate cash receipts. But look at the landscape and horticulture services. These are the people that are doing the installing, maintenance, design work. Very, very labor intensive. And so it's a big employer. Many, many times the value of the farm gate production. And so in terms of thinking of job impacts, horticulture, and particularly the nursery industry, plays a really important role there in the state. We look at housing impacts a lot of times. New housing starts as a signal of what's going on. Jeff's going to talk a little bit more about that as it relates to our wood products industry. You saw the big precipitous drop off there during the time of that recession back in 2008, 2009, where housing starts came to a grinding halt, slowly starting to edge their way up. And as we look at sort of extending that graph there to what's going on now, slow but steady expansion there. Just on the paper here the other day, it looks like we're going to have a really solid fourth quarter for housing starts nationally. But this kind of mirrors how the horticulture nursery sector has continued to grow. So just the last slide to mention before I turn this over, as we're looking ahead to next year, still importance of the direct markets with the produce particularly, more and more interest in the wholesale sector for sure, especially with the auctions and some of our other entities that are working in wholesale distribution, new marketing channels that are opening up, even programs like the farm to school, farm to institution programs. But labor is a really hot button issue for our folks in this specialty crop world, and watching labor reform debates and issues, whether it's in the nursery sector or the production base, as well. You may mention that again in the tobacco side as well, something that's going to be important for all of us looking forward. And then, of course, with the produce side, particularly the Food Safety Modernization Act and quality assurance and how that plays out with our, especially our smaller scale producers, something we're paying very close attention to and trying to do our part through the college to, through our extension programming and training, help keeping our agents up to speed to help our producers with that very important but changing legislation. All right, so with that, let me turn it over to Will. We'll turn.
Thank you, Tim. But the fact is that we're utilizing, on a percentage basis, more and more imported tobacco. If you look at the past couple of years, import use of foreign tobacco by U.S. cigarette manufacturers is probably somewhere between 50 to 60, 70% of all the utilization of burley tobacco in the U.S. market. So that's obviously a very much a concern. And a lot of this is precipitated by the fact of the widening price differential between U.S. tobacco and what I've got shown here on the bars there, looking at the average import price of burley tobacco coming in from Brazil. You can see a few years ago that price differential was fairly minimal, but you can see that the past few years that differential has widened. So that not only Daniel's encouraged more imported tobacco, but it certainly hurt us also on the export side. U.S. burley exports are down to about 60 million pounds. And if you look at, given the fact that we're importing about 120 million pounds the past couple of years, the trade deficit for burley tobacco has been in the neighborhood of 60 million pound deficit. So obviously, a lot of concerns on the demand side, but it's not all bad news, at least for the 2017 marketing season, because of this slide here. World barley production the past 3 years has declined about 40%, and a lot of it's due to the fact that we had a significantly smaller crop, barley crop in Africa in 2017. And as a result of this decline in world barley production, the supply and demand balance going into this marketing season is much better. And we also feel like, Gary, we're going to have a pretty decent quality crop this year. So again, a better supply and demand balance, a better situation in terms of the quality of the crop. Probably looking at overall prices averaging a few pennies a pound higher than we did last year. I would say probably at this point, mid-$1.90s. In fact, some of you all have been selling tobacco the past couple of weeks, been hearing some of you have been averaging around $2 a pound. So again, a little bit better scenario on the price side. As far as dark tobacco, it's the same story I tell every year, that we continue to see some growth in smokeless tobacco product sales here in the United States over the past 2 or 3 decades, but that growth is beginning to slow down a little bit. But needless to say, with a very, very short crop that we had in dark tobacco last year, the industry needed more dark tobacco for 2017, and we responded with more quantity as well as a good quality crop. And prices for dark tobacco continue to be inching up a little bit in terms of the mid-$2.70 range for dark fire cured tobacco, and around $2.40, $2.45 for dark air cured. Combination of higher quantity and quality of burley and dark tobaccos this past year has resulted in a rebounding of the value of tobacco production. We'll probably be somewhere in the neighborhood of $350 million this year. As you can see over the post-buyout era there, despite a lot of concerns, a lot of discussions about the end of tobacco, that really that 10-year, 15-year period or 12-year period has been fairly stable if you look at a trend line through that 12-year period in terms of gross tobacco sales. But I guess one of the major concerns out there of tobacco producers is, even though the gross value is hanging in there, those margins, the net margins, are continuing to get tighter and tighter and tighter. The H2A price that we had to pay our laborers last year was at $10.92 a pound, and USDA announced just a week or so ago, Scott, that that's going to be up to, I think, $11.19 an hour. I'm sorry, $10.92 per hour wage rate in 2017, and that rate's going to go up to $11.19 an hour in 2018. So again, those margins are continuing to get tighter and tighter in growing this crop. As far as 2018, it's hard for me to draw a scenario that would picture the industry needing more burley tobacco in 2018. Again, a lot of it's going to depend eventually, Ray, on the size of this crop and what we end up marketing. But again, the demand conditions would probably warrant maybe 10, 20 million pounds less needed in 2018, Brendan, compared to what we produced this past year. On dark tobacco side, I feel like we'll probably see some stable contract volume for 2018, given the continuation of slow growth in terms of smokeless tobacco products here in the United States. Industry-wide, a lot of attention now on GAP certification, what it means for growers out there. Does that give us a competitive marketing advantage in the world market by having our tobacco certified? What does it mean for future growers out there in terms of the cost of compliance, whether or not that will be a deterrent on staying in producing this crop? So a lot of issues regarding GAP will be part of the discussion in tobacco circles this winter, as well as what is the impact as we move forward on burley and dark tobaccos in these new second generation or third generation of tobacco products being put on the market. Past few years, we've talked a little bit about e-cigarettes and the fact that that market has been growing, but at the same time, those products use virtually no U.S. tobacco as part of the components of those products. The buzz phrase right now, or the product that the industry is focusing a lot upon, is heat not burn. Product that has been sold through some test markets throughout the world. Philip Morris International's put about $3 billion into developing these products. They're lobbying FDA right now and trying to get approval for these products to be sold in the U.S. market. The good news is that, according to industry sources, that they're going to utilize quality leaf as part of the leaf component of these products. But the bad news, or the concerning point, is, Daniel, we don't think there's going to be a lot of U.S. tobacco in those products. So, again, the FDA is going to make some critical decisions regarding the future of these products sometime early in 2018. We're going to have probably some discussion in the tobacco outlook a little bit later on dealing with these particular products. So it's not only this approval of these modified risk tobacco products that's a big issue for tobacco growers regarding FDA, but also the issue of their proposal to reduce the nicotine level in tobacco products, as well as the nitrosamine level for dark tobacco. So again, a lot of critical issues facing tobacco growers on some decisions that FDA will be making perhaps in the very near future. I'm sure this afternoon we'll talk a little bit, Scott, about crop insurance, never-ending issue that potentially jeopardizes the future of the crop insurance program, as well as implications on some of the potential excess supplies that we've had develop in the tobacco industry over the past few years, given that particular issue, as well as what Tim mentioned a while ago, immigration reform, critical issue facing tobacco growers in the future. And the last thing I have up there is, again, relating back to the big increase in tobacco imports in this country. The tariff rate quota for tobacco was established back in the early 1990s when we were producing over 700 billion sticks. Now we're, more than half of that has been eliminated from the marketplace, but those TRQ levels still remain at the same level that we established back in the 1990s. So whether or not the industry will make a move to evaluate those TRQ levels remains to be seen. So all in all, it's the same story with tobacco. These farmers out there, those of you all still in the tobacco industry, you're growing this crop year to year. We know the future looks very uncertain with labor issues and with product demand issues, with a lot of FDA uncertainty. It's still a profitable crop for many of you all if you have some decent yields. But again, it's very difficult to make any long-term implications given all the uncertainty facing the crops. So look forward to the tobacco session this afternoon. And again, hopefully our markets that we've seen early on for the 2018 or 2017 crop will maintain the level. If we can get some decent moisture to come in to help some of these tobacco farmers get the crop to the market in the coming weeks. So with that, we will move on to talk about some of our farm analysis farms and the implications on some of this national and commodity data. What does it mean for individual farms in Kentucky?
Thank you, Will. So we bookend the commodity-specific outlook and projections with the overall economic outlook and projection, and then the in the weeds down on the individual farm impact. So now join me in the weeds. We're going to look at how this impacts farms, commercial farms in Kentucky. Particularly, we'll look at grain farms as our example. We'll be looking at these things: profitability, solvency, liquidity, and cash flow. These are the issues that haunt us, that to define our businesses, not just in agriculture, but in anything, and that we'll look at. We'll be looking at what farmers have done as a reaction to these things, or as to adjust, and where we will have to go in the future. We'll be using as our basis 221 grain farms that participated in the Kentucky Farm Business Management Program last year. These are commercial-sized grain farms. They planted 2,284 acres, 2,248 acres, grossed $1.8 million. Net farm income, historically, as you've seen before, peaked for us in 2013. This group averaged $544,000 in 2013. We didn't do so quite so well in 2014, and net income profitability fell again in 2015 to about that $128,000, almost $129,000 level. Last year, we ended up just about a little below that at $126,000 in net farm income. If USDA's projection of 2.7% increase in net farm income were to be true, we'd be back about where we were in 2015. My opinion is it's going to be a little higher than that. One thing to point out is that this is average net farm income for 221 farms. It's not the same across the state. In the Penny Isle area, net farm income was $200,000 for the average grain farm, a good 58% above average. And in the Ohio Valley, where everything went against them, they went down to about $13,000 in net farm income, about 90% below what the average was. If you look, it's not, this average net farm income doesn't apply across enterprises either. If you look at the livestock, and here I'm picturing dairy at the bottom, that's the brown line. Dairy has not followed the same history or enjoyed the same example of the same high incomes that grain farms have, and last year ended up with a slight negative net farm income. That is, they were doing well to break even. And finally, average means that there are that half the people are below average and half the people are above average. The highest third of our managers averaged about $441,000 net farm income. That's fair income. The low one-third, that bottom tier, as Will mentioned, lost $128,000, so a net farm loss. That compares to about $141,000, I think, net farm loss last year for the bottom third. So that's net farm income. That is the issue, that is the problem that we're facing. How does that show up on the farm? Well, we'll look at the balance sheet and get an idea, a picture of what that's doing to us. Liabilities have increased during this time, leveled out in 2015 and 16 right at $2.5 million for this average grain farm. Grain assets on the farm have also continued to increase and leveled out in 2015 and 16 at $8.6 million. Put those together, and the whole bar would be all of the assets. The red would be the amount that is the banks, the lenders, and the blue portion there would be net worth. So our net worth has kept up. Our net worth has probably grown over this time. We're doing pretty well on our balance sheet. If you look at the solvency ratio, the debt to asset ratio, we're looking at a 29% debt to asset ratio. In grain farming, we don't become concerned until we've hit 30% or gone over a 30% debt to ratio. By the time the farm hits 70% debt to asset ratio, it's not going to survive. It's not going to last. So our balance sheet looks good. Look at the liabilities, the debts that we have. We categorize them in long-term, short-term, or current, and intermediate debt. The current debt is the line on top, the red bar. You'll see that our current debt has gone up every year. That's the portion of, that's our operating loan, that's our accounts payable, and the portion, the principal portion that's due on our equipment and mortgage loans, just the principal portion in the next 12 months. It did turn the corner in 2016, and these grain farms did bring that current debt down slightly. The green line is long-term debt. That would be replacing buildings and buying land. It's mortgage. And you'll see it's been going up. And it went up in 2014, the year after net farm income came down, and in 2015. That was largely taking opportunities to purchase land. In 2015 and 16, that tends to be more of a refinancing issue. We're taking short-term debt and adding it to our mortgage. So the two of them are becoming closer together. The blue line at the bottom is our intermediate debt. That's what we owe. That's the principal payments that we owe for equipment, machinery, tractors, trucks, breeding stock. You'll notice that that line's going down from 2013. I see that as a reaction or a good move on managers' part to pay off more than they're borrowing on equipment. It's not that they aren't borrowing on equipment. It has to be replaced. Cows die. But they are reducing that intermediate debt. When we look at debt, we looked at solvency, we look at liquidity, the ability to meet our obligations in the coming year. And not only do we want to be able to meet our obligations, we need to be able to exceed our obligations with cash and crop and other current assets. Why? Well, there are opportunities that come up that we might need to take advantage of, and there are challenges that we will have to address. You'd like, well, what you see here is working capital. That's the dollars above and beyond, that's the dollars in the bank, in the bin, or in prepaid accounts. That's the current asset above and beyond what we're obligated to pay back for the next 12 months. When we ended in 2013, when we started the downturn, we were sitting on $1 million in cash, crop, and assets, current assets. As net farm income has gone down, cash flow has squeezed us. As we have gone through time, that working capital, that amount above and beyond what we owe, has diminished to $681,000 this past year. That's because we're paying family living or operating expense or principal or non-farm obligations that we have out of our cash reserves, our current assets. A more telling way of looking at working capital is the working capital ratio. That's comparing the current assets to the current liabilities. In 2013, we had a 2-to-1 ratio. We had $2 for every dollar of obligation in principal that we had for the next 12 months. Bankers like to see something above 1.3 or so. They become nervous below that. You see that we've been using up that ratio. We've been using up that working capital. We're down about 1.6, and those numbers tend to follow pretty closely with the drop in net farm income. The average farm is still fairly secure in its liquidity. I'd like to see a 2-to-1 ratio, but we're still working. We're still liquid. If I compare the working capital ratio of the average farm in green to the working capital ratio of our lower third managers, you'll see that the lower third managers never had that 2-to-1 ratio to begin with. It was closer to 1.48 at the end of 2013 when we went into the slide. It's dropped down in the last 2 years to a 1-to-1 ratio. There's $1 in cash, crop, or prepaid expense for every dollar of obligation. That's tight. There's no room for mistakes. There's no room for opportunities. One cow might be the make or break. It's that kind of a close. They're going to get financing from suppliers. They're getting it directly from the fertilizer or the seed or the co-op or somewhere like that. They're probably not. They're probably working with their lenders on refinancing and restructuring at that level. The last slide to look at as far as our financial statement is farm capital replacement. Now, we have a solvent balance sheet. We have some liquidity. We are looking at cash flow now. And what I'm showing you here is the cash flow of all revenue in green from the farm, net farm income, all farm employment, non-farm income, because we don't just farm here, we do other stuff. I'm in business with my brother-in-law. Minus the family living, minus the non-farm expenses and the whatever else is involved there in the person. That revenue in cash during the year compared to the principal payments that are due that year. So we're not looking ahead at what we have to pay in the next 12 months. This was what we had to pay, what had to be paid out that year. And in 2013, we had $273,000 more than what had to go out. That was the revenue was good, and if I was looking at that in 2013, that'd probably justify replacement of some capital, an equipment loan, for instance. Oh, but if we look forward in 2014, 15, and 16, you'll see that our revenue has been well below our obligations to $100,000 in 2015. We didn't have enough revenue generated over all of the outflow for principal payments. I'm not saying that bankers get paid last, but that's the way they're going to look at it, and that's the way we have to look at this. That's why we were using up equity. That's where we're going to somewhere else and trying to borrow or find something to cover this outflow. Last year, managers this average group tended to bring those two lines together, bringing it down to $61,000 deficit. We're not the federal government. We can't live at a deficit. Our loan will get called. What managers have got to do, this average manager, bring those two numbers together. I don't know if that's going to come from an increase, obviously not a 2.7% increase in net farm income, but we're going to have to reduce cost. We're going to have to increase revenue. We're going to have to get cash flow from somewhere, and we're going to have to cut debt. Easy. The last picture I want to show you is not the answer, but it is part of the answer. This is family living for 2016. We do this every year, looking at what family living is for some of these farms. You'll see the big number is on Walmart. It's the expendables. It's everything that isn't something already up there. Medical expense was high. Income and social self-employment tax were down. So was the expendable. The whole picture, $89,000 family living, was down $105,000 the year before. I challenge you to do that at home. And that's probably close to it. I'm not sure that we can cut family living very well. If you look at what's going on, this is not going to make up the rest of it, but it is one of those places that we have to look at. And this is average. Picture is good for those who are average or above. We should be able to weather this, the increase in net farm income, along with some good management in equipment purchases and operating expense, in our non-farm expenditures, and we'll be able to continue. We have to bring those two, the cash flow together. For those that are in the bottom tier, many of those people that you saw in that represented in that bottom tier are going to be out of business this year. It's already happened. It's just a matter of working through the mechanics of getting out of the farm or cutting back. Those that are between middle and bottom are going to be facing that this year, and the decision will be, can I go on into 18 beyond this, or is the game up? Management of getting out of farm is better than no management, and that would be our suggestion. Next, we're going to go to something brighter. Jeff Stringer's going to come up and talk about timber.
We'll spend a few minutes with the forestry sector, some of the commodities we're seeing a lot of movement with right now, and what appears to be a rosy outlook for 2018. Want to thank those in forestry extension, Bobby Ammerman, Billy Thomas, and Chad Nyman for helping with this, and Allison Davis over Ag Econ. Chad will also be, well, that's nice. So Chad will also be presenting all of this in the forestry section this afternoon. So what I forget to say, because I don't have the PowerPoint up here, he'll cover. So I'm just going to go ahead and plow through this, and we'll see what, this will be short. I'll make up time on this one, okay? So also want to thank the Kentucky Division of Forestry and Stuart West. They provide a lot of data that allows us to put this report together, and without that it'd be very difficult. Forestry sector, and we're estimating in this year in 2017 a total contribution of about $14.5 billion to the state. That's the highest level we've seen since we started taking this data, about $9 billion in direct dollars. If you look at how that breaks down with the different sectors, okay, what comes off of family forest and farm woodlands contributes to over half of that, that both direct and total. So what our woodlands do and what comes off farms and our family forest is important, and it all flows through logging sector, which is one of the most fragile right now. And if we ever get a slide, I'll show you that. But anyway, and so we've got it right here. So we did increase facilities in Kentucky. This last year we added 10 of those compared to 2016. So we have over 700 facilities now operating in 110 counties. We have over 2,700 master loggers as well. And that we have plenty of loggers. The health of that industry, though, is pretty suspect and fragile at this point. If we look at our total overall saw log production, we're on a slow increase, which mimics housing starts, and we talked about those a little earlier. Housing is important, as obviously it's an indicator of the overall strength of the U.S. economy, but also the wood components that go into that are critical as well, and does reflect business and commodity prices here in Kentucky. Kentucky is the second and third, depending on the year, leading producer of hardwood lumber in the U.S. So what happens here in Kentucky is important, for the overall timber picture. So if we look at some of the commodities, we've seen some volatility in railroad tie production. Railroad ties are important. We produce a lot of them here in Kentucky. Every acre's got tie log, what we call tie logs on it. And those markets have been fairly soft in 2016 and throughout most of 2017. However, there's significant movement that's going to occur in 2018. We expect an increase in domestic demand, significant increase in domestic demand, which is going to relate to increased prices for tie logs. Okay? We also have an increase in and a steady increase in the price of stave logs. Staves are the vertical pieces of barrel. Stave logs are important, for that industry, for the distilling industry, obviously bourbon and whiskey production, and also for wine. And we see a steady increase in that. It's going to be a seller's market relative to stave logs. Of course, that's just white oak. That's one species. Okay? We see good price support in export markets for ash. We know that we're losing a lot of ash due to emerald ash borer. For those of you that lived in northern Kentucky and central Kentucky, you've seen that. Ash trees dying everywhere. That's moving through the whole state. And so we're seeing a lot of ash that's dying. You can harvest those and salvage those, which is great. And we've seen export pricing support a good domestic price for ash. So that's really nice for those that are seeing some collapse in their ash stocks in the woods. And we expect that to continue. There's also strong an export market for red oak, supporting our red oak prices right now, and that's a good thing as well. One of the sectors that is off and has been off the last couple of years is pulp and paper. And that is because we lost about half the overall market for pulp and paper industry here in Kentucky with the closing of a plant, a Verso pulp and paper mill at Wickliffe, Kentucky. And that's really hurt. That's hurt landowners from the standpoint of $40 to $60 per acre on timber sale prices out in western Kentucky. It's hurt loggers that can't move that material anymore. There has been a lot of a noise about the purchase of that plant. It's idled right now and the reopening of it. The CEO of Verso, who owned that plant, who still owns that plant, indicated to the board that it would be sold by the end of the third quarter. We were waiting for that to happen. There was a lot of movement, people looking at the plant and that kind of thing. And in the end, the word on the street now is that deal fell through. So that whole pulpwood market in western Kentucky is still in jeopardy, still in play. And that's really the only soft spot we have in all the markets we've got. And I have no idea where we're at or what's going on or where we're whatever. One of the things we have seen emerging is the exporting of logs. Now, we've always had some log exports for veneer and that kind of thing to Europe, but what we're seeing now is log exports to Asia, particularly, like I said, the ash, and particularly red oak. So not just red oak lumber that's moving to Asia, but actually logs. So you'll get containers that you'll start to see set up on log yards and that kind of thing where logs going directly into it. That's great from the standpoint of those selling stumpage, landowners, and that kind of thing, and it's good for loggers. It's not necessarily good for our overall industry, but that is a trend that is going on, okay? So overall timber, and I don't know what I missed between now and then, but we're just going to summarize this and we'll get us back on track time-wise, okay? So good thing about it is overall timber markets in 2018 look good. We haven't been able to say that for several years. So we're predicting overall stumpage price increases, which means more money in the pocket of landowners, farmers, that kind of thing. So we see that. White oak demand will be up, continue to be upward trend. The worldwide demand for whiskey and bourbon continues, and that's gonna mean an upward pricing for white oak stave logs. As we mentioned, the tie market should improve if everything holds true. CSX has to replace a significant number of ties in the railroad lines, and that's going to help us with the domestic market. That should help overall. Log exports, as we've already mentioned, to Asia look good. Logging, however, still remains fragile. And the reason it does is because for several of our key commodities, red oak and white oak, even though they're up now, they're the same real dollar level as they were in '05. Okay, so delivered log prices have not increased that much, but certainly the price of doing business for a logger, putting rubber tires on a skidder, all those kind of things, and that their inflation has been fairly high over that period of time. So their margin is tight. Okay? And so while we've got loggers are there, they're still in fragile condition, but overall, from the standpoint of markets and timber markets that landowners and farmers can rely upon, we think next year will be pretty good.
Well, thanks, Jeff. That was impressive. We've got a